Zomato did come out with its earnings yesterday, and in terms of how the numbers fared, well, numbers were a slight miss in terms of what the street was estimating. In terms of food delivery growth, it was yet another quarter of a food delivery growth where it slowed down. Management did indicate that the overall competition in terms of quick commerce is going to weigh on them, and going forward might be impacting the business as well. In terms of quick delivery, the management did come out and announce saying that they are going to shut their quick 10 minutes to 15 minutes delivery platform. In terms of numbers, QOQ revenue is up around 8%, EBITDA down 55%, margins at 1.2% versus that of 3%, net profit down by 34%. In terms of YOY numbers, revenue was up 63%, EBITDA down 16%, margins slid at 1.2% versus that of 2.4%, and net profit was down by about 78%. In terms of segmental performance, food delivery gross order value did see a 16% growth in terms of YOY terms, but Q on Q it did fall by around 1.4%. In terms of average gross order value per day per store, that also fell by about 3%. The overall average order value was down by about 6% QOQ and up 8% YOY. The contribution margin, however, rose by 10 basis points, and this was despite of the kind of lower average value order as well. In terms of other businesses, the losses excluding food delivery and quick commerce stood at around 63 odd crores, and this was on the back of Bistro. In terms of management, they did indicate that innovation and investments will continue at these levels. In terms of key con call takeaways, the management, as I mentioned earlier, also expects competition to pan out in a pretty unfavorable manner, and it might intensify and also kind of impact their overall business. 1/3 of the total going out gross order value was transacted via the District app, but District app also saw an outflow in terms of working capital of around 400 odd crores. Cash was down to 188 billion rupees, and an overall long-term EBITDA margin guidance remained at 4 to 5% of the gross order value and 5 to 6% of the net order value. In terms of what brokerages are penciling in, Citi has maintained buy and hiked the target price to 290. Cash burn is likely peaked out is what they're saying. They remain pole positioned in terms of a large total addressable market, that is Zomato of course, and OPEX increases are largely focused on sustainable growth is what they are saying. Jefferies rates hold with a target price of 232, good Q4, but cautious outlooks is something that is making them cautious as well. They cut their EBITDA estimates by 5 to 15% and want to stay on the sidelines. Nomura retains buy but cuts the target price to 280. They expect food delivery to deliver a 17% YOY gross order value growth, which is not very far away from the 16% that they've done this quarter. And company is not overall burning cash at EBITDA level is what Nomura believes. JP Morgan maintains overweight but cuts the target price to 290. They are saying that they are expecting a sharp ramp up of profit in FY26, but QC losses will extend a tad further than what they were expecting. And overall monthly transacting users might go up by 17%. CLSA lastly maintains outperforming the target price of 295. They've cut EBITDA as well as PAT estimates by 25% and 36% respectively, and they believe that it's hitting all the right milestones, and this is with respect to where quick commerce is concerned. So that's the view with regards to where brokerages stand on Eternal, that is Zomato. Now, in terms of what the management said about the 10-minute delivery, they said that it's not viable for the business. That's one of the major takeaways from the Zomato con call post their Q4 results. Listen in as the management talks about what's working and what needs to change in the quick delivery space.
Bring down the delivery time from the average, let's say 30 minutes for the platform to 10 minutes.
Right.
So I think what we've realized is, I think that is extremely hard, and we don't see any incrementality in demand if we do that on the business, given that customer experience is poor. Right. But of course, there's a wide range between 10 and 30 minutes. So I think our view is that we should try and bring that 30 minutes down to maybe 20-25 minutes over time by sort of making our overall logistic fleet delivery system more efficient. And I think those are the gains we want to chase now, rather than trying to build an extremely quick service, which, without end-to-end control on the supply chain, we think is extremely hard to do.
All right, so that was the commentary coming in from Zomato's management or Eternal's management. It's very difficult to keep a track of the name. Asta, I'll come to you on this one. How did you read the numbers for Eternal Limited, and do you still think that if one wants to make an entry right now in the counter, it's the right time?
I think some dip can be seen before making an entry. This is what we believe, and hence we are recommending to buy on dip rather than at current point of time. Now, talking about the results were quite a mixed bag sort of, because what we have seen, yes, their EBITDA margin, especially as a percentage of GOV, has increased by 10 bips. But now in the bottom line, what we have seen was a drop, and it is mainly due to the accelerated investments in the dark store openings and basically in the quick commerce business also. So I think these results are not very, very attractive, but yes, they are looking to be decent. And we believe that going forward, definitely the management will walk the talk, and we can see strong numbers from them going ahead. So right now we are just recommending hold rather than buy. And our price target, which we are keeping for it, is around 260 odd levels.